Welcome to the overview of financial statements from IME 239. We're going to talk a little bit about the P&L, profit and loss statement, also known as an income statement, the balance sheet and cash flow statement, and show examples of each. Okay, I just said this, didn't I? And what it's used for in determining the financial health of a company, each one of the financial statements. You need to have all three in order to have an accurate picture. So what is it about an income statement that we want to look at? So you can see the yellow box at the bottom. We want to look at revenue, so that's total sales minus cost of goods sold. That's what COGS stands for. Cost of goods sold is how much it cost us to build the product or provide the service that we got revenue from selling. And so revenue minus cost of goods sold is something we call the gross margin. That's how much money we have left over after paying for the product, paying to produce the product, that we can then use for other costs of the company. So the first bullet that's up at the top, you can see the features of an income statement. I know I'm blocking part of it, but is a statement of financial position over a stated period of time. So the P&Ls or income statements you're going to be looking at most likely are going to be over a fiscal year, and you can ask me, are the fiscal years different when we get in class? Or it might be over a quarter, but we really want to be looking at one fiscal year over the other. So keep that in mind when you bring in your financial statements. Revenue is the sale of goods or services. So like you go to Taco Bell, you buy a taco, you pay them $1. That's the revenue for the taco. Then cost of goods sold is how much did it cost Taco Bell to produce that taco. It costs the raw material, it costs the person to put it together, and it costs some portion of the Taco Bell shop and the equipment that was used to make that. And we're going to learn a lot more about cost of goods sold later in the quarter. And then revenue, what the taco was sold for, minus what it cost Taco Bell to produce that taco, leaves gross margin. And we'll see gross margin dollars is what you'll see on the income statement. And you also would want to look at gross margin as a percent of revenue. And we'll talk about that a lot more when we get to ratios. Then after that, we have operating expenses. So you can see down at the bottom, we're continuing on. So we have gross margin minus operating expenses. So these are costs, as it states on the slide there, that are not directly related with producing the product, but you need in order for the company to run. You need human resources, you need research and development, you need finance to put together the financial statements, those kinds of things. So that's what operating costs are. So gross margin minus operating costs gives us operating income, which is also known as EBIT, which stands for earnings before income and taxes. And so then now we've taken revenue minus the cost of the product to build that revenue. We've covered our operating expenses, costs that are not related to the production, and that leaves us operating income, which now is money left to cover other expenses in the company like taxes, interest on long-term debt, those kinds of things. And you can see then operating income down at the bottom here, operating income minus taxes and interest, even though I don't have it listed here, is what gives us net income. And net income is the end-all be-all profit of the company. And as you can imagine, most companies would like to be profitable, and that is an indication, one indication of performance. So that is the P&L. Here's an example. Skyworks is the company that I used to work for. I got this from their 10Q report. It's a filing that they do with all publicly traded companies have to submit every year. And so you can see we have 3 years. So we have the fiscal year ending September 27th of 2013, fiscal year ending October 3rd, 2014, and fiscal year ending October 2nd, 2015. And we can see we have the revenue. So this is the money that Skyworks made based on the product that they build. In this year, they had $3.2 billion, because notice it's in millions. This is how much it cost them to produce the product that they made that revenue off of. This left them with this much gross profit. Profit and margin and income are all interchangeable terms. So you see profit here, income here. Those are gross profit and income are interchangeable terms. Gross is not. Gross is where this belongs. Operating is where this belongs. And net is where this belongs. Those terms are not interchangeable, but profit and income are. And then we have these operating expenses that we covered that leaves us with $1 million of income, that now we use that $1 million of operating income to cover other expenses and taxes, and then once we've covered those, we're left with net income. And so $798 million of net income in this year for Skyworks. And you can see the trend over time. It looks like they've done pretty good. Okay, so that is the P&L or income statement. Next, we have a balance sheet. This is our fundamental accounting equation. Assets, what we own, equals what we owe on that plus what we owe ourselves, already part of it. So think about if you buy a house for $400,000, you put in $100,000 down, and then you get a loan from the bank for $300,000. Is a good way of thinking about it. So total value of the asset is how much you owe on it, or company owes on it, and how much they own themselves. And this is a snapshot in time. So the balance sheet is a snapshot in time. At this particular snapshot, the end of the fiscal year, this is how much I have in liabilities, how much I have in owner's equity, and what my assets are made up of. So I've already mentioned assets are what you own. Most of the time they're tangible. Intangible would mean things that you can't touch, like a trademark, a patent, intellectual property, those kinds of things. But most of the time assets are tangible. The facility, the land, the equipment, those kinds of things. And then we have liabilities, so what we owe could be a loan to a bank, it could be what we need to pay our suppliers, and then we're left with owner's equity, which is what we own. Invested capital, which is maybe stock ownership in our own company, and then retained earnings. A good way of thinking of retained earnings is cumulative profit or loss over time. So if we have profit, it goes into the retained earnings account on the balance sheet. If we have a loss, then it reduces the retained earnings on the balance sheet. And then next we have a little bit more information about assets and liabilities. They're listed from most liquid, so how quickly they turn into cash, to least liquid, how difficult it is to turn into cash. We break up the balance sheet, both assets and liabilities, into current. A current asset means something that can be converted to cash or is expected to be converted to cash within a year. So cash is already cash. Accounts receivable is what people who have been given our product or bought our product or service but haven't necessarily paid for us yet, they owe it. Like what you owe on a credit card would be the credit card company's accounts receivable, and then inventory. All of these we expect our customers to pay us within a year, and we expect to sell our inventory within a year to turn it into cash. And then some liabilities, you should recognize these from the chart of accounts information that you worked on earlier in the quarter as well. Liabilities are accounts payable, so it's what we owe our suppliers. So we may have bought raw material, but we don't necessarily pay for it the day that we get it. We put it on credit and pay for it a month later, something like that. And then accrued compensation and benefits. This might be vacation and retirement, things like that, that the company owes. And then we have long-term, both assets and liabilities, and those are things that we wouldn't expect to turn to cash within a year, but outside of a year. So property, plant, and equipment, we wouldn't expect to sell all of our equipment in a year, but maybe at some point over time we might. And then intangible assets I mentioned are things that you can't touch, like trademarks, things like that. And liabilities, long-term liabilities, loans that you don't have to pay back within the year, but beyond a year would be an example of that. All right, and so here is, I apologize why it's so small here. I couldn't get it to go any bigger. Here's Skyworks balance sheet. So we can see assets, and it's listed current, and then it's listed from most liquid to least liquid, and then there's a total of total current assets. Then we get long-term assets, total assets, and then liabilities and shareholders' equities. Again, we show current liabilities in the order of how quick we're going to have to pay for them, maybe is a way to think about that. We get total current liabilities, so things that we expect to have to pay within a year. Long-term liabilities gives us total liabilities, and then we have the different versions of shareholders' equity. And you can see here, assets, total assets 3.7 million equals total liabilities of 560 plus 3.2 of stockholders' equity. Shareholders' equity is another way of saying that, shareholders' equity, and that gives us the total of 3.7 million. So assets equal liabilities plus owner's equity all the time, and then you can see the trend from year to year too. And then the third and final financial statement that is very important in getting the entire picture is the cash flow statement. So the cash flow statement is what we would put together first in the last in the accounting cycle, and this tells us how and why our cash changed. So our cash balance, if it went from $1 million to $2 million, this tells us what drove that increase, and it could be a decrease as well. But we need both the income statement and the balance sheet in order to put together the cash flow statement. We have three areas that we look at. What cash flow is generated from operations, generated or used from the ongoing business. What cash flow is generated from investing, so used to buy property, plant, and equipment, and maybe some other types of investments, or did we generate cash by selling those kinds of things? And then what cash flow is from financing. So did we go out and get a loan, or did we pay a loan? Did we buy back stock, or which would use cash, or did we issue stock, which we'd get cash from? Those three areas is what you look at on a cash flow statement. Again, the cash flow statement is a reconciliation of beginning cash balance. So here you see down here cash and cash equivalents at the beginning of the period, and then cash and cash equivalents at the end of the period. And this is how the change happened. So we have all of these items here make up cash provided by operating activity, so ongoing business. So in this case, Skyworks' ongoing business was generating cash each year. Again, we have a trend of 3 years. And then we see cash used. In this case, used means that cash went out of our bank account, out of our pocket for investing activity. So we invested, it looks like mostly in property, plant, and equipment here. Capital expenditure is another way of saying property, plant, and equipment. And then we have cash, and here it's a net used because it's a bracket. It means we use cash, it looks like, to repurchase stock for the most part here. And then the sum of all those, the almost $1 billion provided by operations, less roughly $500 million from investing, less $300 million from financing, leaves us with a net increase of $237 million for that. So the 800 that we had at the beginning of the period plus the 237 of cash that was generated during the period gives us our ending period balance of $1 billion of cash. Okay, and you can see the ending period from the fiscal year 14 is the same thing as the beginning of fiscal year 15 with that. And that is the cash flow statement. So quick review, we had an income statement, which is also known as a profit and loss or P&L statement. That shows how much money we made from the product or service we sold, what it cost us to build that. Profit leftovers covering operating expenses. Then profit leftover after operating expenses are covered covers taxes and interest, and then that leaves us with net income. So it shows financial performance for a period of time, a story of the operations of the company's activities for that period of time, typically a year, a month, a quarter, things like that. Then we have the balance sheet, which is assets equals liabilities plus owner's equity, and we know the assets and liabilities are listed in order of liquidity, most liquid to least liquid, and this is a snapshot in time of ownership. For what we own, how much of it do we owe other people and how much of it do we own outright ourselves? And then the third and final is a cash flow statement, and it's to reconcile between cash and accrual accounting, which you'll do a little bit of research about, and show how cash is being generated. Did our cash balance change because of ongoing operations, because of investing or divesting of stuff, or from financing? All right, so you're going to bring your 3 financial statements, income statement, balance sheet, and cash flow to class, and we're going to do some analysis of your company's financial statements. And the next 3 videos that are posted will give you some indication about how to go through the actual analysis now that you know what each of these income statements are, each of these financial statements are. Thank you.